Welcome, friends. Welcome to this session organized by Let's Share in association with TeamLogic. This session is on section 194R, which is TDS provisions on business perquisites. And to take this session, we have with us none other than Mr. Ashutosh Mahajan. He is a very senior professional chartered accountant of 1990 with 32 years of experience, rich experience with him. He doesn't need any introduction, but just for participants who may not be aware, he has worked with industry for almost 20 years and also worked in consulting for more than 12 years in Big Four. And as recently as 2 months back, he was the finance head of Samsung Electronics. Now he is the managing partner of TeamLogic LLP. I invite Ashutosh sir today to deliberate on the issues which are plaguing the industry in reference to section 184R. And my request is to all the participants to please keep your mics on mute. We'll take the queries later on once we are done with the discussion. And we have kept it an interactive session. We have placed a lot of examples, practical issues which are arising out of the section itself and the circular which has been issued recently, circular number 12. So there are a lot of examples which have been given in the circular, but these examples probably are not exhaustive in their own sense. And even the examples which are given create a lot of issues within themselves. So this create legal challenges in how to interpret them, what are the provisions, and also it creates a little issue in terms of the practical implementation of the provision. So with this, I invite Ashutosh sir to share his views on section 194R.
Thank you, Anshul. Good evening, my colleagues. It's good to be back, amongst you. And now we take it forward with the presentation. Next, Anshul. Next, Anshul. Yeah. So this is all, go back. Yeah, this is all what we are going to cover in the presentation today, basically with objectives, the law, meaning of, one of the term which is significant, guidelines to be laid before the houses of the parliament, significance of this, then, the circular which has been issued and what are the issues, coming out of the circular, and then based on interaction with the professional colleagues, over the last 10 days, we have gathered, I think, 12, 15 questions, which we'll try to answer. And after this presentation, the House would be open for question and answer. To the extent, we are able to answer, we will. And rest, will be parked for future. Next slide, please. So, to know the objective, with which any law is incorporated, normally what we do is we go to the speech of the finance minister, what the finance minister said in the parliament, to understand, what was the intent of laying the law. We also look at the documents, budget documents, which are published, when the proposal is laid in the House of the Parliament. So we looked at the speech. Interestingly, the speech says, it's not on the slide, but the speech says that in the course of sales promotion, a lot of benefits gets provided to agents. So now it started, from benefits being provided to agents. So that was the start in the parliament, in the budget speech. And then, when you look at the memorandum to budget 2020, of course, all withholding tax provisions are proposed and enacted to widen and deepen the tax base. And then, from agents, the intent moved to section 28.4. It says that, the benefits and perks which are covered in 28.4 are taxable in the hands of recipients. And since recipients don't offer these, benefits to taxation in their returns, and therefore, there is a need to put a withholding tax provision in the law to take care of, the taxability of those benefits. Next, please. So let's look at section 194R itself. The basic provisions, we have just put it here in a very simplified language. 194R says that there is a provider of benefits, and the provider can be any person. All of us knows that any person is a much wider term, and apparently it can include the non-residents and foreign companies. As we move along, we'll see whether what position to take or what to do with the, this kind of definition which comes in to play in the section, and whether this section will have extraterritorial application in this case. Benefit may or may not be convertible into money. Now this is in line with what is there in section 28.4, but somewhat it gets diluted with the proviso and the subsections which are there in 194R, where this has been read as synonymous to benefits being offered in kind or cash in kind or totally in cash. So may or may not be convertible into money, may not exactly mean offered in cash. We'll discuss it more and the implications. Further, benefit must arise to recipient from business or exercise of profession. Arising from business, the term itself is a well-settled term with the Supreme Court judgments around it. We'll cite some of those judgments and how this term is relevant in the application of this section along with the circular. Recipient must be a resident, so this will not apply where the recipient is a non-resident. TDS need to be deducted at 10% of aggregate value. This is fine. Tax to be deducted before providing such benefit. Now this itself raises a lot of issues and we'll discuss in detail. In case of benefit in kind or the cash element is not sufficient to meet TDS, a deductor to ensure that deposit of tax has happened before the benefit is released. So this is one, and it has in some situation it has some implications. Next, please. Threshold for recipient, INR 20,000 in the hands of each recipient. Threshold for individual and HUF deductor. Only these two categories. INR 1 crore in case of business and 50 lakhs in case of profession. First proviso to subsection 1 gives an indication that benefit given in cash is also covered by the provisions of section 194R. We'll see going forward what does it mean. Power to issue guidelines, so they've already exercised those powers and issued guidelines in the shape of a circular 12 of 2022 and guidelines to be laid before both houses of parliament. This is something the significance of which must be understood in true sense. Next, please. So arising from business, this principle has been discussed in a lot of judgments, and some of the judgments we have cited, these are Supreme Court decisions. It basically means that, income or the benefit which is being talked about is arising in the usual or ordinary course of business. It also means, which is very important to understand, that every receipt or income or benefit which is being received, in the conduct of business, cannot be said to be arising from business. So this is very important to understand, that while you carry out the business and there is income, or there are receipts or benefits which are coming to you while carrying out that business, but each receipt, simply because it is received in conduct of the business, cannot be said to be arising from the business. And with the examples which we'll discuss in the last, we'll see how this will apply. 194 will not apply to any benefit arising to an employee. 192 would apply, and 194 will not also apply to any non-business recipient of such business benefit. For example, companies do extend a lot of benefits to ultimate consumers, and who they are consumers and they are non-business recipients. And 194 will not apply to those consumer schemes. Okay, so the significance of the guidelines to be laid before each House of Parliament. So far, historically, what we used to know of the law, or what we even today know of the law, is that a section in the Act is the law, which is passed by the Parliament. Now, circulars, which are issued in direct taxes by CBDT, they are of explanatory or they are clarificatory in nature, and circulars are binding on the revenue, but they are not binding on taxpayers and courts. So this was the understanding which each of us had all along while we practiced taxation. Now we see new trends of legislation which are coming into play in the last 2 to 3 years, and they are mostly around the withholding tax provisions which have been introduced in the last 2 to 3 years, and some of these have been cited here. For example, Section 194O in Finance Act 20, Q in 21, and RNS in 2022. All these sections, carry a subsection which says that the guidelines would be issued. If there is a need for clarification, guidelines would be issued, and guidelines would be placed before both houses of Parliament, and those would be binding on the taxpayers. So obviously, the circulars or guidelines which earlier used to be only clarificatory, now will have a force of law, and these would be binding on the taxpayer. And this has its own implications, which we'll discuss. Next, please. So the question was that the why there is a change in why Government of India wants to make a circular or the guidelines not clarificatory, but they want to make it binding on the taxpayer. So while researching Section 28(4), we just came across one of the judgments in the case of Mahindra and Mahindra, where on a very particular question of waiver of loan for acquiring capital assets, it was decided that this cannot be taxed as a benefit or a perk in the hands of recipient, because the receipt is in the form of cash payment. So the Supreme Court basically laid down that Section 24 covers the benefits which are only given in kind. Now, this is the judgment of 2018. And this was the settled law, till now, when this, before this circular came about. So I'll just prepone one of the questions, which are there in the circular, which is question 3. And question 3, basically, again, in the circular, it's talk about Mahindra and Mahindra in 2018. Now, this is something, which is very frightening, that there is a Supreme Court judgment, which is a settled law on 28(4) in respect of waiver of loan for, acquiring capital assets. And then, with an example of a High Court judgment, which is of 2016, which is earlier, and you want to cite this, High Court judgment to bring home the point that irrespective, whether this is a benefit or not, but for the purpose of withholding, we will always treat it as a benefit. And this is something, which is very frightening about this whole concept of a circular being placed in the House of Parliament to, basically override, some of the settled position, which are already settled by Supreme Courts and maybe other courts, to the extent of, that you recover your withholding taxes by enacting, Section 194R. So this is the implication of, what will happen if guidelines are laid, before each house of the Parliament. Obviously, these are laid down to be passed, and obviously this would, later on will have an assent of the president, and then it will have a force of the law. Now the question is this is something which I've cited only one of the examples. Similarly, if a circular which carries 10 such examples based on tribunal judgments, High Court judgments, which are in favor of the revenue, and there are other judgments settled law position or already in public domain, and you rush to the Parliament to make it as give it a legal force, then obviously what you are trying to do is you are trying with one stroke, you are trying to undo all those judgments which are settled in favor of the taxpayers. And this is something which is frightening about this. And my personal view is that this is a question which probably need to be taken to constitutional experts on whether this is challengeable in the court of law. Subsection 2, CBDT can issue guidelines to remove difficulties. Well and good. But the real question is that once you issued a circular, did you remove difficulties? You created a lot of difficulties. And the other important question is that can the guidelines increase the scope of the section? Even if these guidelines are placed before the House of the Parliament. This is a question again, which need to be taken to constitutional experts on whether it can be challenged. Next, please. Now we come to the circular, and there are questions in the circular. For example, a deductor not to check if amount is taxable in the hands of recipient. It's in line with most of the TDS provisions where the deductor deducts tax on the gross amount paid without actually worrying about what is the income element in the payment made or whether it is taxable at all. Taxpayer only has an option to go for either a lower or a nil withholding tax certificate if that he wants to escape withholding taxes. And this section is defendable because there is already a Supreme Court judgment cited in the circular in relation to 194E in favor of revenue. The real question is that section may be defendable, but whether circular is defendable. And why I'm saying so, ordinarily, when you say that it's a withholding tax provision, and you are not to bother about the taxability of the receipt or the income element within that receipt, it's well and accepted because the law is worded in this fashion. The real question is that when you frame this law, there is a sitting Supreme Court judgment which says that a particular receipt is not a benefit. And then by citing an example in the circular, you are still trying to withhold tax on that particular receipt, which is already held as not a benefit by Supreme Court, to be subject to withholding taxes. This is something where the whole issue is and where the challenge should arise from the taxpayers. Question number 2 says that benefit perk need not only be in kind. Now, we have seen, a Supreme Court judgment which says that 28(4) covers only benefits in kind. But now, this section itself and the questions in the circular, they are exceeding, the mandate which was presented to the Parliament in the form of memorandum. Next, please. Waiver of loan I've already discussed because there is a direct correlation with the Supreme Court judgments. Question number 3, this is a question which was posed by somebody, whether the bad debts would stand at par with waiver of loan. The answer in our view is no. It's not a bad debt, it's not a benefit provided. Debtor simply doesn't have money to pay, and there is no waiver of right, on the part of provider. It may have a bad settlement of debt, probably may have a different treatment, and we'll talk about it later on. Question number 3, in one of the examples has also listed down, some benefits being given to director without distinguishing, whether the director is an employee or not. Obviously, if director is an employee of the company, then 194 will not apply. And if it's a non-employee director, then also, it need to be seen whether, the benefit which arises to him can be said to be arising to him from business, because that is the basic condition of the section. And this needs to be decided, on a case-to-case basis. Next, please. Question number 4 is on discounts, and luckily for all the taxpayers, they have considered most of the discounts or sale deduction given against sales as not a benefit, which is a happy position. Now the question is that whether post-sale discounts given due to quality issues are also covered in that. The answer is yes. Any post-sale discounts, which are sales deduction and which are given as an adjustment to price, would fall within the exclusion of question number 4. Question number 5 is on valuation. Though, they have said that in case of item purchased, the price at which it is purchased has to be, should be the value of the benefit. And in case of sale, in case of goods manufactured, the value of benefit should be, the price at which, that manufactured good or product is sold. Now, the issue here is, and it's a common problem, that neither the goods, same goods are purchased at similar price, nor they are purchased at, nor they are sold at, similar price. So what should we do? What price we should adopt in this case? Our view is that in case, you are able to identify the benefit and actually identify the benefit and the cost around it or the price around it, then please go by that. Otherwise, some method, for example, a weighted average method, need to be adopted, which then need to be followed very consistently, all across in compliance with this section. Question number 6, product given to influencer. This is on a return. This is a twist on question number 6. That whether product given to influencer for longer duration on returnable basis and given on a justified business reasons, whether it would be considered a benefit. The answer is no. I can take an example of a mobile phone given to an influencer with a condition in the contract that he need to hand carry the mobile, every time he's out of his home. And then, once the new model comes in, he returns the old model, and a new model is given to him. In this case, it is on returnable basis for justified business reasons, and should not be an item covered under 194R. Next, please.
Yeah. So can I add something on these things?
Go ahead, please.
So this will surely create some problems for the from the deductor's point of view, because say, for example, if it is for a longer period of duration, say 1 year or 2 year down the line, and for the tax auditors also, because if the tax auditor is going to audit it, and if he is going to evaluate whether the TDS was required to be deposited or not, he would probably go with the contract which is in place. However, how and when was it returned or not returned, this will be very difficult to be pursued by the tax auditor. And similarly, in case of, however, by the time when the assessments comes up, probably at that point of time, the contract time may have expired, and therefore the companies will have to demonstrate and document the returning of the asset which was provided to the influencer, or to influencer is just an example which has been given, but even to a distributor or any kind of a person who has been given. So these kind of things and documentation and evidence will need to be built in by the companies, and a mechanism will have to be put in place so that the accounting team is aware about the kind of time period mentioned in the contracts, and whether at the end of that contract the asset was returned or not, and how it was dealt with at that point of time. Similarly, in terms of items manufactured and items purchased, as Ashutosh sir mentioned, that this is very difficult for a company which is selling, and it may happen that during a period of time, the different items are sold, same item is sold for different prices to different people. And at that point of time, the endeavor of the income tax authority will always be to pick up the highest sale price as the benefit provided whenever it is provided for free of cost to someone. Whereas for the deductor, it will be difficult to identify which item costed which at what amount. So a few options which can be followed is the FIFO item. Say, for example, if the items were purchased by a company and then provided to somebody else, then you can maintain a FIFO, or if you maintain a weighted average cost of inventory, probably at that point of time, what was the cost of inventory, that need to be maintained and documented so as to identify the value of the benefit provided. Similarly, in terms of items manufactured, they are also sold. Now, what happens is the item may be sold to some person at X discount and to another person at, say, for example, X plus Y discount. So there can be different ranges of discount which have been provided. So should we take a standard price or the MRP? MRP may not fit in the bill, because if the manufacturer is selling to a distributor, and if the circular says that at what price I sell, the provider of the benefit, at what price the person sells to somebody else, that is the price needs to be taken. So if we take MRP, it may inflate the benefit in the hands of the recipient. So MRP is, to my mind, out of question. Now, if I'm selling it at different prices, it needs to be seen that what kind of valuation methodology is going to be adopted by the income tax authorities in terms of, and there is no clarity which has been provided in the circular. It just says that one price. They have assumed that it will be sold at just one price. So probably some more clarity needs to be provided by CBDT, and with issuance of this circular just a couple of weeks before the implementation date, it creates a lot of challenge for the industry also to implement this in real sense. Okay, sir. So let's move on to question number 7. Out-of-pocket expenses. So do you want to take it?
Good.
Okay.
Yeah. So interestingly, in question number 7, Anshul, we are missing you a lot in speech. So my request is you slow down, when you're speaking, so that everyone can hear you clearly. Go ahead, please.
I think my network is little unstable. I'm not sure why it is so, but I'll take it ahead. So question number 7 is about out-of-pocket expenses, which are incurred by almost everyone in rendering of services, or even in the case of distributors and resellers, whenever certain expenses are incurred on behalf of the
Anshul,
principal.
you are not at all audible.
Okay, please allow me a couple of minutes to rejoin through a different network. Kindly bear with me. Am I audible now?
Yes.
Yeah, Anshul.
Great. So coming back to question number 7 of circular 12, which talks about out-of-pocket expenses. And as Ashutosh sir had mentioned, that the section talks about benefit and perquisite, benefit or perquisite, which was settled, which phrase has been interpreted by the Supreme Court in the case of Mahindra and Mahindra. And it was settled that anything given out in cash will not be covered by the phrase benefits and perquisites. However, and in fact, the section 194R also uses the same phraseology while putting a charge in respect of withholding tax. However, when the circular came out, they have referred to the proviso to subsection 1, wherein it is mentioned that where the cash component of the perquisite is insufficient to withhold the tax, then you must adhere and you must ensure that the tax has been deposited by the recipient of benefit. Now, by citing that proviso, the circular tries to put forth a viewpoint that benefit and perquisite can also be in cash, and therefore they have tried to cover by citing examples that if the reimbursement is provided to anyone, any service provider, that reimbursement is also in the nature of benefit and perquisite, which is subject to TDS under section 194R. Now, this is open to challenge. However, as mentioned, that this is a circular which is going to be placed before both houses of parliament, and one can say, the revenue can argue that this is a legislation which has force of law because it has been passed by both the houses of parliament, and therefore it somehow tends to extend the scope of original section. In terms of question 7, they list out the various examples in terms of when and how reimbursement can be taxed, and one of the exceptions which they provide is that only in case the invoice is taken in the name of benefit provider directly, only in those cases reimbursement of expense will not be taxable, not be chargeable to TDS. Now, they have overlooked the argument that out-of-pocket expenses is negotiated, and generally whose liability it is. If it is a liability of the provider of the benefit itself, then why TDS should be applicable on the recipient of reimbursement? If we would see the question number 7, the answer to this question starts with the language that any expenditure which is the liability of a person carrying out business or profession. Now, when we say that it is the liability of a person carrying out business or profession, probably that needs to be seen from the facts of each case, whose liability it is. Say, for example, if I have agreed to a fees, a lump sum fees, which includes all my expenses, and within that particular cap of fees, something is billed as a fees and something I'm just asking them to reimburse as an expenditure. In those circumstances, probably the liability was of the service provider itself, and the income tax authorities may allege that this is a benefit liable to TDS. However, if it was not, and it was pre-agreed that the reimbursement of expenses will be provided by the service recipient itself, then somewhere an argument may be taken that pure reimbursement, wherever the reimbursement is backed by actual invoices, should not be taxable. However, if this position is taken, please be rest assured that it is going to be challenged by the income tax authorities if the invoice is not directly in the name of benefit provider. So these are few issues which arises out of this particular question number 7. Then moving on to question number 8, which talks about dealer conference. It gives an example as to when and how the dealer conference can also be treated as a benefit. It says that if it is provided to all the dealers, then it would not be treated as a benefit. Now, what happens is that large companies do have a significant number of dealers or distributors, and it may not be possible for the organization to call all the dealers to a particular conference. And they would definitely apply certain filters or certain criteria to list out or to call for those distributors who are well performing and for whom they foresee a good business perspective. Now, if we strictly go by the circular, in such scenarios, there may arise a question that it is a benefit or not, because there was a selection and only selected dealers were called for the conference. Also, the circular says that the leisure trip or the part of the expense which is attributable to leisure trip should be treated as benefit in all cases. Now, the examples can be, say, for example, if there is a trip of 3 days, 2 days is in the conference and the last day is in the leisure trip. So how you are going to attribute the expense to that particular thing? How the benchmark is to be done as to what amount needs to be taxable, need to be subjected to withholding tax under section 194R. So these are the questions which have not been clarified. These are the issues which have not been clarified in this circular, and probably there is definitely a need for further clarifications to be provided by CBDT. Then we come to the question 9 of circular, which talks about benefits, perks, wholly in kind or partly in kind. Now it says benefit provider to ensure that payment of tax before providing benefit and perk, and recipient to deposit equal amount of advance tax and share the challan along with the declaration to the provided who relies on the same. Now this provision is there in the section itself under first proviso. But this is a practical challenge that how it needs to be complied with. Now, in most of the cases, when the benefits or perquisites are being provided, the cash component is either going to be very minimal or it is going to be absent from them. In all those circumstances, the proviso says that before releasing the benefit, you must ensure that the advance tax has been deposited by the recipient of that benefit, and a copy of the challan for deposit of that advance tax has been provided to the provider of benefit itself. And they have also amended the TDS return in order to accommodate the reporting of these kind of advance tax challans. Now, if you are having a number of distributors or number of people to whom these benefits are being provided, the number of the kind of reporting it will need to be made in the tax returns, in the TDS returns, it is going to be enormous. Also, to ensure that before releasing the, because many times it may happen that the travel package is scheduled for, say, within few days of your booking, and to ensure that the person receiving the benefit has paid the advance tax well in time before going and moving on to that trip, it may pose real-time challenges for the business teams, because these are generally the distributors or these people are being dealt by the sales team, not by the finance team, right? They are front-ended by these people. So the finance team and the tax team need to ensure that all these guidelines are placed before the sales team, and need to ensure that a mechanism is put in place to comply with this particular provision. Now, it is also not clear if, say, for example, somebody has provided me a wrong declaration and a wrong advance tax challan. Now, I may not be aware that a person is getting a similar kind of benefit from somebody else also. And if a same challan is used for different people, it may happen in some cases, may not be entirely, may not be in 100% of cases, but in even in 1 or 2 cases, if this kind of defaults happen, who will be held liable? Whether it will be the benefit provider who will be held liable, or whether it will be the person who received the benefit would be held liable, has not been made clear. And even in the law, in the section 194R, there is no provision which clarifies this particular aspect. Secondly, if some companies are also contemplating that we will recover the tax from the benefit recipient. Let's say, for example, if a tour package of 1 lakh rupee is provided to one dealer, in those circumstances, what we can do as a benefit provider, we can recover 10,000 rupee from that person, rather than asking him to deposit deposit advance tax by himself. We can say that, please give me 10,000 rupee and I will deposit your TDS in your name. Now, this situation is something which is neither captured in the statute, nor this is captured in the circular. So in that situation, it is not clarified whether I need to pay that TDS before releasing the benefit, or I can club this amount with the regular TDS and deposit it before the 7th of the next month as per Rule 30 of income tax rules. Now, income tax rules cover all the TDS sections apart from a few of them. 194 O, S, Q, a few of them are excluded. And for all these sections, including 194R, it says that the TDS can be deposited on or before 7th of next month. But in a situation where the benefit I provided was not sufficient, the cash component which I provided was not sufficient to deposit TDS, and in that situation where I've recovered the amount, that is not clear whether it needs to be deposited before the benefit provided or on the 7th. So this also creates a little bit of compliance issue, because if you have deposited on 7th, probably the income tax authorities may come and say that you have not ensured the tax being deposited before the benefit was released. Now we move on to some of the practical examples which we feel that will be there, and some of the practical situations where the challenges will be predominant in order to comply with the provisions of section 194R. Now the first example is, if year-end provision is created for the benefits to be provided to dealers, but benefit is actually provided in the next year, at what time the TDS under section 194R should be deducted? So the view which arises here is, the language of section 194R is such that it does not say, it does not use the phraseology of or deduction of tax at the time of credit or payment, whichever is earlier, as is generally used in other sections. So probably in this particular kind of language which has been used in 194R, we can safely conclude that the liability to deduct TDS will only arise at the time when the benefit is being provided and not at the time when the provision is created in the books of accounts. Sir, would you like to add something on this?
No, I'm good on that.
Okay. So there are a few queries also which have been mentioned in the chat box. I will request the participants to kindly wait for all the practical examples to be covered, and probably your query may get covered within these practical examples. If it is not covered, we'll definitely take up the issues after the examples are over. Okay, so the next issue, the next practical situation which arises is settlement of loan or debt at a lesser amount. Now, why this question arises is because of the example cited in question 3 of circular 12. Now, example which has been cited is about principal loan waived by a bank under a settlement scheme, which would, and they have quoted a case law of Ramaniam Homes Private Limited 2016. As Ashutosh sir has already mentioned that in Mahindra and Mahindra, the Supreme Court has overruled this particular concept, this judgment, wherein the Supreme Court has held the meaning of benefit and perquisite to be only in kind and not in cash. And it was exactly on the waiver of loan itself. The issue under consideration was waiver of loan, and Supreme Court held that because the loan was originally granted in cash in money terms, the waiver of the same can also not be would also be treated in cash terms only. So it will not be considered to be in the form of benefit or perquisite. Now the issue is, first issue is whether it is a benefit or not. And just by mentioning an example in the circular, it is not saying that this is something on which TDS has to be deducted in specific terms. They have just mentioned a few examples, citing the case laws and stating that in these examples, court have held a particular amount, a particular situation to be in the nature of benefit. Now, if this case law has been cited and which has already been overruled by the Supreme Court, can we hold that this example holds good in the circular? Probably not. So this is open to challenge. Secondly, the section itself mentions that any benefit or perquisite has to arise from business. Now, if I have taken a loan from bank, taking and giving loans is not my business. My business probably may be dealing in goods or services. My business may be manufacturing. My business may be providing services. But taking and giving loans is not my business. So if, and also in terms of a capital asset, if I have taken a loan in terms of a capital asset and that loan has been waived, can it be said to be arising from my business? It is open to challenge. And as a taxpayer, I can very well argue that this is something which is not arising for me from business. Even if you would see section 41(1), which talks about the cessation of liability, that also talks about only those liabilities which were claimed as deduction under the trading liability head. So only a trading liability constitutes a business income in terms of 41(1). So at best, this can be treated as other income, maybe as other income, maybe a capital receipt not chargeable to tax. But within the terms of section 194R, what benefit and perquisite can be subjected to withholding tax is only those benefit which arises from business. So therefore, a settlement of loan or debt at a lesser amount, probably this is also open to challenge. Thirdly, a bad debt. Say, for example, if I had sold a good to someone and I was to recover some amount, and that amount is now not recoverable. Can I be said to be provider of a benefit to somebody else? I have not given it voluntarily. I am being forced to give it. I am not even able to recover the amount of my goods supplied or my services supplied. How I am supposed to recover the amount of TDS, and how I am supposed to enforce the deposit of advance tax from that particular person? So this is going to be a compliance challenge also, even if the income tax authorities were to allege that it is arising from business. First of all, one can always argue that this is not a benefit provided by the person who is incurring a bad debt. Ashutosh sir, do you want to add something on this?
I think you have covered all the points.
Okay. So let's move on. Corporate guarantee or brand usage free for it can be either provided free of cost, or it can be provided for an inadequate consideration. Now the issue arises whether this guarantee, corporate guarantee, can be provided at the time of obtaining bank loans. Most of the time subsidiary companies do not have adequate credit worthiness so as to obtain loans from the banks, and in those circumstances the loans are backed up by guarantees from the parent company. The parent company can either be Indian parent or it can be a foreign parent company. Now the question arises whether this benefit provided to a subsidiary company by the parent company, can it be treated to be arising from benefit from business? To my mind, it may not be. Why it may not be? Because I am not transacting with a parent company in course of my business. The corporate guarantee may have been provided out of the sheer apprehension of protecting the investment in the subsidiary company or the group company. So the benefit which arises to the recipient of the corporate guarantee may not be said to be arising from business itself. Now, it may differ from facts of the case. There may be certain circumstances where the two companies are transacting in business. The person is a debtor, and the company has to take a loan in order to repay the loan to somebody else, and there a corporate guarantee is provided. Probably in certain circumstances, there may be a situation where it can be said to be arising from business, but in most of the circumstances, it may not be. Secondly, if the corporate guarantee is provided by foreign company, the argument of extraterritorial jurisdiction of this particular section would come into picture. As a taxpayer, someone can take a plea that the non-resident company is not governed by the Indian laws. They don't have a nexus. They are just safeguarding their own investments, their group company's interest, and it is something withholding tax provision is generally not applicable, generally argued not to be applicable on a foreign company, and there are a few case laws from tribunal level in Sanofi Pasteur and a few other cases wherein it has been held by the tribunal that extraterritorial jurisdiction will come into play and TDS provision may not apply to a foreign party. If you would also recall, there is an explanation too which has been inserted in section 195, which says that provisions of section 195 will deem to be applicable on non-residents also. So to the extent wherever the statute wants to make these provisions applicable on non-residents, they have to specifically provide in the law. And fortunately, at this point of time, in section 194R, there is no provision, there is no subsection or proviso which says that, or no explanation which has been provided that a benefit provider, if it is a non-resident or a foreign company, it would apply to them also, right? So just by saying that benefit provided to a resident may not be sufficient to say that even if the benefit provider is a non-resident, then the section will apply. So this is a plea which can be taken. Obviously, this will be open to challenge, and income tax authorities, considering the way they have come out with this circular, trying to cover each and every part of each and every kind of situation which would have been against the revenue, we can foresee that this position may also be challenged. Then we come to the next question of sale of demo products at less than FMV. So in electronics industries, in a lot of other industries, wherever the demo products need to be provided, it is seen that the dealers and the distributors are sold those products at a highly discounted prices. Now the question arises whether if the discount is quite high and it's not in pursuance of the normal sales discount or normal cash discount policy of the company, whether it can be alleged that such discount, high discount or heavy discount, is within the nature of benefit or perquisite subject to withholding tax under section 194R. Now, our view is that question 4 is very clear in terms of discounts and rebates. It also talks about rebates. So therefore, any kind of rebate from the sale price itself, if it is agreed at the time of sales or even at a later point of time, but is within the contract of sale itself and to be adjusted against sale price itself, then it should be covered within the purview of explanation provided in question 4, and they should not be treated as benefit because discounts and rebates have been excluded from the purview of section 194R by question number 4 of circular 12.
Anshul, one thing to add here, that demo products are generally, they are sold at a discounted price, but there is also a condition, which is put at the time of sale, that the products would be displayed on retail counters for a specified of time, and the demo products contractually cannot be sold immediately. So by the time this demo period is over, they've already lost a lot of value in terms of the sale price. And obviously, discount in any case is out of the purview of 194R. So given the business situation, I think a position can be taken that 194R will not apply.
Right, absolutely. Okay, so now an allied question to the sale of this to the discount provided against sale. Many times it happens is that a few reimbursement which are to be made to the dealer or distributor or to anybody else, what happens is that those reimbursements are not given in cash or in kind, or they are just adjusted against the sale price itself. Now, there is now this issue arises whether this will be treated as a discount or it will just be treated as two different transactions which are now getting set off against each other. So one was a sale which has already happened. One is the cash reimbursement which you have to make, but instead of making that cash reimbursement in its own sense, you have adjusted and set off the two transactions and merged them together. In that particular scenario, it will be difficult to argue that the cash reimbursement or the adjustment in the sale price is not a benefit, because that was not against the sale but against certain other reimbursement which had happened. And the reimbursement question is quite clear in terms, it clarifies and specifies that any kind of reimbursement if you are making, it will be treated as a benefit until and unless the invoice is directly in the name of the benefit provider, right? So in that sense, if the sale price is adjusted on the aspect of reimbursement, then the same may not be considered as a discount.
Yeah, I'll pick up the next one, Anshul.
Sure.
So the next question is sharing of marketing costs by distributor reseller. So in business situation, it sometimes happens that the marketing cost, of course, the marketing costs are incurred by the manufacturer, but they are also incurred, in a tier distribution scenario by tier 2 and tier 3 in their own markets. And sometimes organizations do have policies that a portion of those costs, is reimbursed to either a tier 2 dealer or a tier 3 retailer. Now, one thing, which we need to understand is that when the goods are sold, from manufacturer to distributor and further, they are sold on a principal to principal basis, meaning that, the ownership and title also gets transferred. And then, the retailer or the distributor, he decides in his own, decision making to incur certain marketing expenses to sell the goods which he owns. Now, if company later on decides that, some of those costs can be reimbursed under, based on production of evidence or partly met by the manufacturer, then obviously this would be a benefit which is provided to tier 1 dealer or a tier 2 retailer. The next question is product reimbursement to influencer in startups without product return. So whether you give a product, or whether you reimburse cost of the product to the influencer, if the contractual obligation is not there on the influencer to return the product over a reasonable period, which can be justified for business reasons, 194 will apply. Next question is on reimbursement of marketing cost to marketing agencies, where TDS is otherwise deductible under section 194C. Now, I think first of the question is that if it's a pure reimbursement, then why even TDS should be deducted, under 194C. So my view is that if it's a pure reimbursement, in the sense, it has been held in the judgments, then even 194C will not apply. Marketing agencies, if they're acting as pure agents and they meet all the conditions of the pure agents, and with this circular in place, now they additionally take invoice in the name of the principal, then obviously they can get out of the mischief of 194R. Non-resident providing benefits, perks to resident. Again, this question of extraterritorial application of law. Things have moved on this subject quite a lot, in a different context. Mohit Minerals very recently talked about even nexus with the territory of India, sufficient to put a GST there. So our position is that since this whole issue of 194R would be debated on each and every benefit or so-called benefit which is coming out of the circular provided to recipient, our base case in case of benefits being provided by a non-resident should be non-application of this law in extraterritorial application of this law. And then, as Anshul said, that from there we take, we see where it goes. And obviously there is sufficient precedent where government has gone back and changed, those laws retrospectively. But this argument must be taken and should be taken. Next question is on, startups giving equity shares to professionals, brand ambassadors, and not deducting TDS. Now, if for services, consideration is paid in kind, then obviously, tax need to be deducted at source based on the nature of service. It should already be deducted. And if, the value of consideration in the form of shares, the fair market value is equal to the cost of service, then obviously, we are not looking at anything in 194R. We should look at 194J or 194C, or as the case may be. However, if the fair market value of shares allotted is more than the cost of services, then probably there would be a case of a benefit being passed to the service provider, and 194R may come into the application.
Sir, I want to add here
Please.
something.
Sure.
In terms of startups, what practically happens is, in most of the cases, the startups are in losses in the initial stages of their business, at the point when they are giving these shares to professionals or brand ambassadors or to mentors or to many other people. They generally enter into agreements that you provide services to us, or you be the mentor to us for 2 years, and then we will issue you these shares. Till the time the shares are issued, most of the times it happens that the company is still in losses, and the shares, the net worth of each share is either negative or less than their face value. And if you would see how the fair market value of shares is to be determined in terms of income tax laws, there is a rule, Rule 11 UA, and wherever the shares are getting transferred or issued, also one of the methods which has been prescribed is NAV, net asset value method. Probably it may be said that if the shares are issued at fair value, if the shares are issued at face value to the professional, there is no additional benefit which has been provided to the recipient of such shares. So that is also one of the issues or one of the arguments which can be taken in startup ecosystem, that this is very, very relevant whenever we are dealing with startups, because the first and foremost thing would be to determine whether a benefit has been passed on or not. And if we can demonstrate that the price which has been charged from such professional or person is at face value, which is more than the net worth of each share, then there is no benefit at the first place which has been provided. So this is something which we can consider when we are dealing with startups.
Anshul, you can take the subsequent ones.
Okay, so
can I add something here?
Go ahead, please.
Hello.
Yeah, go ahead, please.
yeah, Manish.
Yeah. So see, in case of transfer of shares, NAV method is prescribed under Rule 11 UA, as you mentioned. But in case of fresh issue of shares, then it says DCF method under the income tax rules. It even doesn't say any internationally accepted valuation method. It says DCF. So when new shares are issued to professionals, in kind, then they have to be done as per DCF, not as per NAV, and which would mean that they would have some value. So if suppose previous rounds based on DCF were raised at say 1,000 rupees a share, then that value will be assigned for 194R, in my opinion.
I would differ, Manish. DCF is one of the options provided, and NAV is also listed in that particular sub rule. So, and also if you would see the scheme of things, while transfer of shares and while issuance of shares, these are two different schemes of law. While we are issuing shares, this law which is prescribed is section 56(2) clause 7B, which says that if the share premium is received above a particular fair market value, so it talks about the higher price, that you cannot go beyond that price. That is the upper limit which has to be determined, So it says that if share premium is received beyond the higher limit, we will tax it as other income. Now, while determining that higher limit, it prescribes both the methods NAV as well as DCF, and it says at the option of the SSC. And that is the primary reason of dispute between the taxpayers and the income tax authorities. And this is the law which is called angel taxation in normal parlance. So wherever the taxpayer is determining the value at a DCF methodology, the income tax authorities at the same point of time always argues that it is the NAV which is the fair market value and not the DCF, and therefore it tries to bring down the value by using the NAV value prescribed under this rules 11 UA, and say that whatever share premium you have received is in excess of the amount of the fair value. Also, if you would recall that there is a notification from DIPP which has been adopted in the Income Tax Act also, which says that if you are a recognized startup and if you have filed a declaration in Form 2 regarding certain conditions which need to be fulfilled, you will be exempted from the application of this 5627B. So, keeping that apart, Rule 11 UA provides both the mechanisms, NAV as well as DCF. And why this is provided is because there has to be set up an upper limit of share premium which can be received in that transaction. However, while we are issuing shares, we are determining the fair market value as per the income tax law, and it is at my option which I can choose, and it is not mentioned in the rule or in the law that if I have chosen one value, one mechanism for one transaction, I cannot choose the other mechanism for any other transaction. So the law is very open in this particular aspect. So probably to my mind, it will be open for the taxpayers, for the startup companies, and also for the mentors and the professionals to argue that whatever I have received is at fair market value till the time the the NAV of each share is below the face value. That is my view.
No, I will just add to it that. So what happens is, it is clearly mentioned, like when there is a issue of shares for the new proceeds, DCF method is prescribed under a separate rule, I think 11U. And if there is a transfer of shares, it has to be under 11 UA NAV. So in case of transfer of shares, they have just prescribed one method, which is NAV only. And in case of new issue of shares, they've said DCF only. While under Income Tax Act and FEMA, they talk of internationally accepted any method. Right. Now, in case of 194R, what issue will come is if there is a new issue of shares to a professional, suppose I am advising a startup and I get share, tax authorities would want me to go for DCF, not for NAV, because that would give them more tax under 194R.
Manish, we can discuss it separately because I'm pretty sure that both the methods are prescribed for 5627B also. And rule is very clear, NAV, because I'm fighting case litigation in that aspect, that we have argued DCF, we have adopted DCF in issuance of shares, and the income tax authority has referred the same rule in a particular subclause wherein NAV method is also prescribed, and the assessing officer has followed NAV method to determine the fair market value in order to determine the excess share premium.
Okay, we'll discuss.
Yeah. So let's move on. Now the issue with a practical situation which can also arise is companies are giving cashbacks or incentives or probably some gifts in kind to plumbers, carpenters, or painters, or even to retailers, right, who are in their chain of business, but they are not the direct entity whom we are interacting with. Say, for example, if a manufacturer entity deals with distributors, distributor will then deal with sub-distributors, and then sub-distributors will then further deal with retailers or the actual people who are using their products in their business, their own business, right? Say, for example, if a carpenter is using certain tools and if he's again and again purchasing some consumables which are used in his particular business, and the manufacturer of that consumable product provides certain benefit to that carpenter, it may be said to be arising in the business itself, right? However, the circular says that it is because of a relationship which the company OEM manufacturer has with the direct seller, direct purchaser of the goods. So in that situation, a question arises that 194R, the threshold which we need to see of 20,000 rupee, will it apply to per person who is at the end of the chain, business chain, or whether I am passing it through my distributor? Then I'll have to see the consolidated amount of benefit provided to my distributor, which is again then passed on, and whether TDS will be then deducted in the entire chain for each of the person. Say, for example, I provide the goods to distributor, then distributor sends those goods to sub distributor, and then sub distributor again sends those goods to the retailer. Then how it is going to happen? Whether at each leg 194R would apply or not? This is a question, open question, probably may not apply. But someone, income tax authorities may come up and say that at each leg you need to apply. Secondly, the threshold which we need to see as per the language of the circular, they have cited an example of hospital dealing with a pharma company. And that particular question, they have mentioned that the tax is required to be deducted by the person in name of the recipient entity, since the usage by the owner is by virtue of their relation with the recipient entity. Means they say that I, as a manufacturer, am providing benefit, even if to the last end of the chain, my relationship is with the distributor which I am dealing with generally. I am not directly contractually obligated to provide anything, or not contractually engaged with the retailer or the plumber or the carpenter or the painter. So in that sense, the threshold of 20,000 should be looked at the amount of benefit which I have provided to the distributor. Would you agree with that, Ashutosh?
This is there in the circular. I think this is the position which government has.
Yeah. So probably if somebody is thinking of that, we can just open up different accounts in the name of the retailers and see that the limit of benefit passed on is below 20,000 in a year, and we can escape the charge of section 194R. Probably you must revisit the position and think over it before taking that.
Correct.
Now, coming on to the next situation, which is reimbursement in case of invoice when it is in the name of consultant or auditor. Probably this is very clearly defined or illustrated in the question number 7. Till the time it is in the name of consultant, 194R will apply until and unless the invoice is directly in the name of benefit provider.
And
Then,
let me pick up this one.
Sure.
So this is, this is very much prevalent in the consumer goods and appliances industry, where, in the process of branding, furniture and fixtures, they are placed at the retail counters, and mostly, these are given free. Now, the real question is that if we look at it from the perspective of, the retailer, obviously, these have come to him, these are arising to him from the business. And these are fairly large amounts, in any organization. So the question here is that what will happen, whether, these would be treated as item liable to 194R. In terms of treatment of these items, mostly in my personal experience, I've seen that once, these are put at the retailer's end, these are charged off to profit and loss account as a marketing expense. So our position is that once you charge it off, though maybe contractually, you might have agreed that there is a clause to repossess those items. But actually, in your last 20 years of business, you have not even possessed a single item, repossessed a single item, and there is no empirical data to show that you have actually done it. Then probably it is very difficult to get it out of the mischief of 194R. On the other hand, if there are assets which company keeps on the books, which are provided to retailers, there is a policy which says that those would be repossessed in terms of whatever the terms of the policy are. And historically, you have been repossessing those assets from whomsoever you have given. You might be scrapping those assets at the end of the period, but you must be repossessing those. Then probably a position can be taken that these assets are given on a returnable basis, and therefore it's not a benefit, and probably 194R should not apply. Now, this returnable basis, of course, we have picked it up from the circular only, and this would be tested in the larger amounts. Go ahead, Anshul.
Now the question of Esops. This is also a very common issue, wherein the Esops are provided to the employees of subsidiary companies or the affiliate companies by the parent company. The parent company can either be Indian or it can be a foreign company. Now the issue again arises that if the parent company is providing Esops to the employees of a subsidiary company, whether the benefit can be said to be arising from business to the subsidiary company. Now, if the company is operating, if the subsidiary company, say for example, is operating as a back office service provider to the parent company, and if we can say if there is some amount of business transactions which are happening between the two companies, and if it can be evidenced that to secure the business interests of the foreign company, the shares or the Esops have been issued to the employees of the subsidiary company. In those circumstances, probably one might say that it is arising from business, but wherever it is just a parent subsidiary relationship, there is only investment which has happened, or there are a few business transactions which happen, which are not commensurate to substantiate the kind of benefit which has been granted in the form of Esops to the employees of subsidiary, then a position may be taken that it is not arising from the business of subsidiary company. One is this argument which we can take. The other argument which can be taken is obviously the extraterritorial jurisdiction, wherever the Esops are being issued by a foreign company. The question of extraterritorial jurisdiction will always come up, and as a taxpayer, one should never forego that claim until and unless decided by the court. So this is it from our side as of now, from the question side. Now let us take a few queries from the chat box which have been mentioned by participants. Sir, I'll take the question and you may answer them.
So let's take the questions and you answer it, and I'll intervene, wherever I need to add anything.
Okay. So the first question is from Pawan.
Can we put it on screen?
No, it is on chat box. So if you can open the chat box, it is there in the chat box.
Sure.
So question 1 is from Pawan, which says it's given free trial subscription for some day. Is it covered under section 194R? Well, free trial subscription, it's a challenging one, but if it is subscription given to the ultimate consumer, then the question which you may need to ask is whether it is arising to that particular person from his business or not. Now, if the free trial subscription is given only to consumer, you may very well say that it is not arising from business to that particular recipient of benefit. So whenever we have to see arising from business, that has to be from the perspective of the recipient of benefit and not from the provider of the benefit, not from the perspective of provider of the benefit, right? So in case your free trial subscription is given to a ultimate consumer, probably it may not arise. However, if you are giving free trial subscription to a chain of distributors, to people who are ultimately going to resell it further, it is open to questioning by income tax authorities, and they may come and challenge that this is a benefit which has been passed on. Ashutosh sir, what is your view on this?
No, so the entire, the premise of section 194R, if we go back to the speech, it says that, expenses get incurred in sales promotion, which result in a benefit. Now, obviously, if it's a free, a trial subscription, for me, for anybody who is giving it, it's a sales promotion. If I give somebody a free trial, obviously, we are giving him an option to check it, enjoy it, and then later buy it. But if the underlying section, which is in place, which we are discussing, the entire is that if it results in a benefit, it should be taxed, then obviously, we are in a tight spot. However, I agree, with you that to the extent, these are being given to recipients who receive it in the, for whom this would be arising from business. Only in those cases it should be taxed. Probably the argument here can more be whether, even in case of those businesses, whether we can say that it is arising from a business. I think arguments need to be built on that side. There may be a case that, because this is a new thing, we need to, it still need to be tested. So the only argument I see is that this free trial subscription has been received by me or has been given to a particular business, and it is not arising to him from business.
Yeah, and the similar question is from Pawan. So Pawan, referral, gift voucher, cashback, reward points to the end customer may not be said to be arising from business to that customer. So probably in that situation also 194 may not apply. But obviously you need to see who is your end customer. If your end customer is also someone who is carrying on business, say for example, I have mentioned plumber or carpenter who is ultimately using your products in their business. And if by virtue of using the raw materials or consumables, they are getting certain benefits from the supplier of that consumables or manufacture or products, then someone may say that even the end consumer receiving such vouchers and gifts can be said to be receiving these gifts in the course of business, means arising from business. So that needs to be seen from case to case basis. Probably in your business, this may not arise, right? So Umapati Mishra is asking referral gift, cashback, reward points to end customer. Okay, I think he has answered this question. Pawan is asking if holding company giving ERP rights to use with no cost, is this covered or not? ERP rights, sir, basically the IT softwares or certain proprietary software which are given by the parent company for use to the subsidiary company in India. In that case, again, you may argue, Pawan, that this is not something which is arising from business, because until and unless you are in some business transactions with your parent company, and if these ERPs are being given for use to you only to maintain the group reporting or in order to maintain the standards of the group, probably an argument may be taken that this is not arising from business. Obviously, this is open to challenge by income tax authorities. This argument will need to be built upon. And secondly, obviously, whenever this benefit is being provided by a foreign parent company or foreign affiliate group company, the argument of extraterritorial jurisdiction in terms of TDS provisions can always be taken up. But obviously, as of now, to our mind, you will definitely try to defend the positions by saying that this is not subject to 194R.
Okay.
So, do you want to add something to this?
No, I'm good.
Okay.
This argument is fine.
So,
I think you left one question from Chandrakumar.
No, that is the next one.
Okay.
Are free trade samples provided to facilitate actual product sales covered under 194R? I think yes, these are very much covered. Free samples are actually the basis and genesis of this particular section. Right, sir? Do you agree to this?
And this has been specifically mentioned in
Mentioned
the
circular.
circular.
Yes. Abhishek has raised his hand. Abhishek, I would request to kindly wait for some time. Can we extend for 5-10 minutes, sir?
Yeah, of course.
Okay.
My request would be, let's take
Queries, right?
all the queries.
Yes. Okay. So Amrit Devra is asking whether gift items received by distributor and given to retailers, whether distributor required to deduct TDS from retailer. Amrit, as I mentioned in my when I was discussing with that example, the entire chain may be asked to be covered by the income tax authorities. They will say that once the manufacturer provides the distributor, this is also subject to TDS. Then when distributor provides to the sub-distributor, it is also subject to TDS. Then when sub-distributor provides it to retailer, that is also subject to TDS. Obviously, provided that the threshold limit of 20,000 is breached in every leg. Now, from an income tax standpoint, when the distributor received the benefit and has passed on the entire benefit to somebody else, from an income standpoint, it will be tax neutral because you received an income and then you booked an expense. So if you received a benefit of 1 lakh rupee, you passed on the benefit of 1 lakh rupee. But ultimately what happens is that the blockage of TDS becomes bigger and bigger if the chain is longer, right? So at the first instance, 10% TDS will be deducted. At the second instance, 10% TDS will be deducted. And at the third instance also, the TDS will be deducted. So that is probably a view which is very clear from the circular. Right, sir?
Yes.
Okay. So coming to our next question, Sheetal Jain, in case of reimbursement, well, what will be the case for custom clearing agents? Many bills at the ports and CHA name, which they take reimbursement from the company on cost to cost basis. If it is in the name of CHA, you will face a challenge because in terms of circular, the clarification provided in circular, it is very much clear. Probably if the customs duty is paid, customs duty reimbursement is being made, that is very much clear that customs duty will definitely be paid in the name of the party. Right, but if there are any other expenses which are being claimed and the bills and invoices are in the name of CHA, this should get covered within the purview of 194R. Then moving on to the next question, where Umapati Mishra, whether gift item received by distributor and given to retailer, going by the language, yes, may not qualify as income though. Okay, this is just a statement. Then Ashok Prabhu is asking, incentive to push sales during sales campaigns was considered as commission for purposes of 194H. There seems to be a change in the stand now. Yes, sir, to my mind, there will be some overlap which will happen between sections. And probably the reimbursement will now being specifically covered under the purview of section 194R, they would tend to charge a higher tax rate in terms of 194R. I think 194H is now at 5%. So this is going to be a challenge. Sir, do you want to add on to this thing?
Also, the question here is that incentive to push sales, incentive to push sales happen regularly, in all businesses. And so far, my understanding of that incentive is this is not passed as this is always passed as discounts and sale deduction. If these are because what you end up doing is you end up reducing the price of the product to leave a higher margin, with the reseller. This is one way of doing it. The second way of doing it is that, in case, your policy says that, on a given achievement, it's on a percentage basis, then obviously, it will hit by, I think 194H is already there. So I'm not sure whether, if anything is already covered by one section, then why 194R will apply, but maybe we need to see, if tax officer goes for a higher rate of TDS.
That is because of this example given in the circular, because one of these examples is covering this point also.
Yes, sir. As I mentioned, this circular is opening a lot of can of worms. So there will be a lot of litigation which will arise because of these examples which they have cited, and there is overlap between existing sections and this particular section. There is overlap in many of the examples. Say, for example, the reimbursement. Say, if we are into a contract, if we are into some contract and then we are claiming reimbursement, say probably the TDS would have been deducted under 194C. As in the case of professional services, TDS is deducted under 194J for reimbursements also many times. So in all those situations, say if the tax rate is 10% versus 10%, probably nobody is going to have any challenge, because just different section applying doesn't bother anyone. But wherever section 194C would have been applied or 194H would have been applied in earlier scenario, and now there is another overlapping section 194R, there is all the chances that the income tax officer is going to challenge and say that you have defaulted in withholding tax. Obviously, it is open to litigation and open to challenge. Coming on to the next question, Amrit Devra is asking whether 194R triggered or interest-free loan given to friends and relatives for their business purpose and interest-free intercompany deposits. Amrit, the moot question which will be there is whether it is arising from business for the persons who are receiving loans from the friends. First of all, we need to see whether they are transacting with us in business or not. If they are just obtaining loan, they may not be said to be taking, in the business of obtaining and giving loans. So just financing their business and receiving interest-free loan, to my mind, the basic argument against the applicability of 194R should be in terms of whether it is arising from business or not. And only on those aspects you will be able to defend it. So you want to add something to this?
Correct. Go ahead, please.
Okay. So another question is from Ashok ji again. Advance tax can be paid in quarterly installments. Whether only payment of due installments is enough? Also, what if there is only a single challan for advance due in a quarter? So, sir, this advance tax which is paid quarterly will not come into play for this particular section, because it specifically mentions, the proviso specifically mentions that the benefit provider needs to ensure that the advance tax for this particular transaction has been paid off before releasing the benefit. So I'll have to obtain actually for each of the benefit I am providing, or if say for example, some consolidated benefit has been provided. For that particular benefit, for that particular amount of TDS, I'll need to produce the challan to the benefit provider. So I cannot say that I'll pay it when my advance tax becomes due. I'll not be able to get the benefit till that time, because the benefit provider is under an obligation to ensure that the advance tax has been deposited before releasing the benefit. So that is very, very clear.
Correct.
And obviously, this is going to create compliance challenge, no doubt about it. Then Tejas Shah is asking, subsidiary company get loan at a lower rate of interest due to corporate guarantee provided by a parent company. Is it covered under this section? Sir, again, the interest rate is being provided, lower interest rate is being provided just by the banker or the financer of the transaction. Again, the same logic will apply whether it is arising from business or not. Say, for example, if you are an NBFC itself, right? There are NBFCs who are also taking huge loans from banks. Now, if they are into the business of giving loan and taking loan, probably in that circumstances, someone may argue that giving a loan at a lower interest rate. But again, the question arises that bank, when they are providing the loan, they will evaluate a business circumstance, and whenever they are providing the interest, how are we going to first of all just demonstrate that it is at a lower rate? First of all, that is also a question, that how it is going to be demonstrated that it is a lower rate. It is going to be a challenging situation to my mind. I would ask Ashutosh to throw his views on this issue.
So I think the one point, Anshul, which you already covered, was that the concept of arising from business. So if the loan is cheaper to me, and we'll come to the cheaper part later on, but it is not arising to me because I'm not in the business of lending and borrowing, then obviously this will take us out of 194. The second question is, which you raised, is very pertinent, that why we are calling it a cheaper rate. You are not the only ones who will be receiving this kind of loan from the banker, provided a similar kind of a corporate guarantee is provided. So my view would be that in this situation, the argument falls more in favor of the conclusion that 194R doesn't apply.
Okay, so let's move on to the next query from Divya Shingari. The recipient of furniture fixtures where 194 was applied, will the recipient be able to capitalize it and claim depreciation? The actual cost should be nil in terms of 143.1. So Divya, to our mind, the person should be able to capitalize it and the cost will not be nil now. Why? Because an income has been deemed to arise in the hands of the person. So for example, if it was provided in cash, so that person would have applied that cash to purchase the asset. Now what has happened is that the cash portion has been taken away. Let's understand in the terms of accounting entries, how it will happen. When I am receiving a benefit and I have to receive an income, I have to record an income in my hands. Until and unless I record an income in my hands, I'll not be able to claim a TDS. So when I record an income, I credit the professional income, I have to debit something. Now, what is that amount which I will debit? I will debit the asset. Now, asset debit to professional income. So when I record that asset in my books of accounts, I have earned an income. I have earned an income, which is, which is in the form of that asset itself. So that income, when I have declared it and offered it to tax, probably we cannot say that it is come for free to me. There is a cost to it. So to my mind, the definition of actual cost in terms of section 143.1 should not come into play here. Sir, you want to add something?
I think you got it covered fully.
Okay. So, okay, this is again the same question. Then also intercompany transactions such as Esop, these would be anyway covered and reported in TP docs. So the genesis of non-reporting of receipt of benefit going unreported should not be triggered here. Absolutely. But again, whenever TP is applicable, probably the question of extraterritorial jurisdiction will come into play, and also the basic issue of arising, the benefit not arising from business will be there. I'll request you to all please keep the mics on mute. Okay, then Saurabh Jain is asking, there may be a situation that you are manufacturer of a consumable which you need to give to distributor or agent to provide the quality of the product to win. Sorry, I'll read it again. There may be a situation that you are manufacturer of a consumable which you need to give to a distributor or agent to prove the quality of the product to win the bid or otherwise. Should that be covered? Sir, yes, Saurabh, to my mind, it should get covered. Any kind of sales pitch, benefit, whichever way you are providing, it should get covered as a benefit if it exceeds the threshold limit of 20,000 rupees. Okay. And why so? Because it is very clearly mentioned that any kind of benefit you are providing, it should get covered under 194R. Manish Tiwari is asking, company appointed agency to provide trip to dealer 194 applicable to whom and how? Company appointed agency to provide. Sir, ultimately, if I am bearing that expense and if the company is directly providing that agency, if that agency is directly giving the trip or vouchers or the travel packages to a dealer, then obviously I will be considered to be providing that benefit to the dealer, and 194R should apply. Yes, sir.
And there is company appointed agency to provide trip to the dealer. So
Right.
there is an agent in between, right?
Right.
So when the person is acting as an agent, he is acting on behalf of the principal.
Right.
And one is that the expenses incurred on behalf of the principal, and second is his agency commission. Now again we are going back to the same question, that if the agent is incurring expenses on behalf of the principal, whether the invoice is in the name of principal or not. So that would
sir,
probably
in this particular case, even if the invoice is in my name, the benefit is provided. It is a trip which has been provided. So in any case, if a leisure trip is provided, even if because this is not a reimbursement. This is not a reimbursement of expense.
No. Okay, so we'll argue later on outside this box. Yeah. So we agree to disagree. My view is that in this particular case, if agent and going by the circular, if agent gives me a consolidated bill, even if to the extent of expenses, he's only recovering the actual cost, but the invoice from the third party service provider to the agent is not in the name of the principal, then obviously agent would then this reimbursement would be liable to tax, and in my view it would be liable to tax at both ends.
Sir, what would happen if I directly purchase a travel package? Means as a company, I purchase a travel package and give it to the dealer. Now the invoice will always be in my name. The company from whom I'm purchasing the benefit is always going to be in my name. So for example, if I purchase all the assets or all the gifts which I have to give, bill will always be in my name. So if I am providing that benefit, passing on that benefit to somebody else, probably that argument of bill being in my name may not work. That is my view.
So you carry on with your view, and we have already agreed to disagree, right? So why to put a burden on the audience, right?
Right. So
Yeah.
Abhishek is asking repeat extraterritorial jurisdiction concept in case of foreign parent company. So Abhishek, why we are saying extraterritorial jurisdiction concept will come into picture is that because these are TDS provisions. and TDS provisions can apply only to the person who is governed by the act. Now, in terms of a non-resident who is outside the jurisdiction of Indian territorial waters or territorial jurisdiction, one may argue that just by transacting with an Indian party, the TDS provisions will not cover that foreign party and not oblige them to withhold TDS in terms of these provisions. Say, for example, if I as a consultant am providing certain services to a foreign party, right, and I am receiving a professional service fee. So now, as per section 194J, TDS is required to be deducted on any payment made to a resident against fee for technical services or fee for professional services. So if we are going to apply these kind of provision to each and every non-resident transacting with an Indian company, it will be a chaotic situation. So in those sense, we are saying that generally in 194J, 194, any other kind of provision, foreign party is not subjected to TDS until and unless specifically provided for in the Act. Say section 195, explanation 2 has been specifically inserted thereon, specifying and providing a deeming fiction that provisions of section 195 will always be deemed to apply on a non-resident also. So until and unless there is a specific provision being brought in the law, in the statute, we can always argue and say that this is extraterritorial jurisdiction if section 194 were to apply to a provider of a benefit who is a non-resident. Right, sir?
Yeah, so, this subject has not been tested fully even by the revenue. So one question is that, though I agree with you that this is an argument which we must take, but look at, probably say advice given by a professional to an overseas client, right? Now, in our experience, we have never seen, those cases being, those overseas clients being advised to, take it a TAN registration in India and do a withholding tax. While, you go out in industry and always advise that on a conservative basis, let's ask the foreign company to take a TAN and do a withholding tax. Another question probably which might be relevant here is that, for example, in terms of services or in terms of benefits provided by, in those cases is that, again, relevant to the services provided to the overseas clients, that where those services are, benefit is coming, where those are consumed. So those are the issues which are still open, but I think I agree with you that in case here, the difference here is that the benefit is provided to, an Indian resident, and given the case laws, there can always be a nexus, which can be established subject to the principle of arising from business. But since, on this particular law and the circular, there are so many things, which taxpayers would be litigating. I think this point of extraterritorial applicability of this law should always be, should also be challenged along with that.
Okay, so the next question is gift to customer senior employee as a gesture or courtesy during business meeting or festival like Diwali, will it be considered under section 194R? Yes, sir. If it crosses the threshold limit, it will definitely be considered as subject to withholding tax under 194R. Rajiv Talwarji is asking how will the wet lease of cars be treated under where the insurance and repair is in the name of the owner but reimbursement by company as part of lease? Sir, are you asking in the case of employee-employer relationship, or how is it? If you can just please clarify. Contractor. how will the wet lease of cars be treated where the insurance and repairs is in the name of the owner, but reimbursed by the company as part of the lease? Okay. Oh, so probably this is a case where I have taken an operating lease. I have taken an operating lease, say for example, for 30,000 per month, and there are repairs and maintenance charges which are to be charged an extra over and above that lease rental. So to my mind, sir, if these expenses are in the these invoices are in the name of car owner and they are getting reimbursed from the company, 194 will definitely apply to my mind. There is no escape. Sir, do you agree to this?
Yes, I agree.
Okay. So, okay, then there is one more query. I think this, let's take it as a last query, and then probably because we are nearing 6 o'clock, if anybody has any other query, please feel free to reach out to us. We are definitely connected on phone. Manish Joshi is asking, what's the due date when payee pays the tax in form of advance tax? Anything specified? Yes, sir, it is very much specified. It is specified that before the release of benefit to the person, he has to deposit this as advance tax, and this is specified in first proviso to subsection 1 of 194R. Continuing with the question, company appointed agency to provide a trip to the dealer. Company deduct TDS under 194R of the agency, or the dealer or the company will deduct agency and agency will deduct dealer. Now, sir, agency means, are you saying that I am paying first to the agency? Agency is just acting, agency is not getting any benefit in this. That is a business transaction for them. So benefit is being given to the dealer. So to my mind, that is my view. If the dealer is getting the benefit, so I will ask the dealer to pay the tax and provide me the advance tax challan. That is what my view is. Obviously, Ashutosh's view is that if the invoice is coming to me in my own name, then TDS under 194 is not at all required to be deducted. So these are the two views which we have discussed right now in one of the questions raised earlier. Right, sir?
Yes.
Okay, I think so. Let's. Sir, any closing
Anshul,
remarks?
no, so before we close out, I just want to leave a thought with you. And that is around, this whole concept of a circular being placed in front of both houses of parliament. Now, the question is that, and I also said that, this is something which, given the, tone and tenure and the examples of the circular, need to be seen very closely, whether this is something which can be challenged. The idea here is not to challenge the power of the legislature, to probably enact something, or probably even bless, the circular which has come out. What I'm trying to say is that what need to be seen is that Parliament may have all the powers, within their right to enact a law or probably bless a circular like this. However, whether, the government, which is the executive, knowing fully that, Supreme Court of India has laid down laws and there are issues, which are already settled in terms of arising from business, in terms of, waiver of loan and so many other things. Whether knowingly, where all those issues have been legally debated and have been settled, whether they have a right to ignore those, settled position and probably pick up cases from tribunal and high courts, ignoring those settled position, and then, rushing to the rushing to the parliament to get it blessed, whether they have a right to do so. And this is something, where my personal view is, we must put a challenge to the circular in the form in which, it has been put to the business. That's all, I wanted to say. Thank you so much for hearing us patiently. We may have been right on a few things. We may have been, still in question mark on a couple of things. But it was a wonderful debate. Thank you so much.
Thank you, sir. Thank you, everyone, for taking out time this evening and patiently hearing to us. We'll keep on bringing further sessions on topics of interest, and keep tuned in to the channel of Let's Share. And also, we'll invite suggestions on which topics you will wish us to bring in further sessions, and we can bring in different professionals and experts on the subject matter to help us out in that particular area. So thanks a lot, everyone. Have a good day and had a good evening. Bye. We are signing off.